In the last few years, the tools to provide financial support to firms, nonprofit organizations, and projects with significant social and/or environmental impact have changed. In this clip, I will briefly discuss these changes and the alternative finance tools that have been introduced. I will start with the nonprofit sector, that in the past has been the one in which there were the majority of projects with significant social and/or environmental impact. I will then introduce alternative finance mechanisms that governments are starting to use. And finally, I will talk about the financial tools that are being offered to firms aiming at having a positive impact. Traditionally, nonprofit organizations received grants from foundations and governments, and donations from private individuals or philanthropists and firms or corporate philanthropy initiatives. While these financial sources are still important for nonprofit organizations, many of them are now also providing services to attain more stable revenues. They are offering services both directly to clients and to government agencies willing to outsource their welfare services. For instance, the services that these government agencies should offer to their citizens. Given this new focus on services, nonprofit organizations are more interested in financial support to cover these more predictable costs of their operations. However, they need to learn about the possibilities, and they have to be helped to introduce financial management competencies in their organizations. One of the reasons why nonprofits are trying to offer services is related to a shift in the preferences of their traditional funders. In particular, governments are reducing their contributions and shifting them towards welfare services, as discussed above, and toward impact-oriented bonds that I will introduce later. Meanwhile, firms are shifting towards strategic philanthropy, that is, social projects that are aligned with their competencies or their context. For instance, a coffee maker will not donate anymore to every social cause, but will focus its financial support on local producers, organic farming, etc. Also, foundations and private donors are shifting their focus toward financially sustainable, or at least more sustainable and organized projects, adopting what is increasingly called a venture philanthropy perspective. To be funded, projects and organizations increasingly need theory of change, logical framework, impact evaluation, sustainability plans, etc. In addition to what we have already discussed, to support impact projects, governments and governmental institutions are introducing alternative finance mechanisms, such as social impact bonds and green or climate bonds. A social impact bond or pay for success bond do not offer a fixed rate of return. Repayment to investors is contingent upon specified social outcomes being achieved. For instance, the first social impact bond was launched in the UK at the end of 2010 to finance a prisoner rehabilitation program conducted by nonprofit organizations. A social impact bond is a public-private partnership. It is an investment in a social project where the government passes on part of the savings achieved to investors. If the objectives are not achieved, for instance, if reoffending is not reduced, investors receive neither a return nor repayment of principal. Similar, but normally not requiring an impact evaluation, are green bonds or climate bonds. These bonds are issued by governments, but can be issued also by multinational banks and corporations. Their proceeds are used to fund environment-friendly projects, such as energy efficiency, pollution prevention, sustainable agriculture, protection of aquatic and terrestrial ecosystems, etc. Nonprofit organizations are not alone in conducting projects with significant social and/or environmental impact. Increasingly, for-profit firms are focusing on these projects, as the green bonds already illustrated exemplify. In particular, a new type of firms is emerging that tries to pursue both a positive social impact and a financial return. These firms are called in many ways by different scholars and organizations. They are called social enterprises, social businesses, purpose-driven organizations, sustainable organization, benefit corporation, etc. In any case, as highlighted in the figure, they can be considered hybrid organizations because they are in the middle between non-profit and traditional for-profit businesses. These companies operate in fields such as renewable energy, housing, healthcare, education, microfinance, etc. We can complete this figure to summarize traditional and alternative finance tools to fund social impact projects and organizations. We can do this considering the expected returns and the different organizations funded. On the bottom left side, there are traditional nonprofits and traditional philanthropy. Here, the returns are negative. The donors do not expect to see their money back. Also, on the bottom left, there are venture philanthropy and public support that we talked about before. These support are more advanced. They are paying more attention to the financial sustainability of the organizations. But they are still expecting to lose money or see below market returns. In the middle of the figure, we can see impact investments, normally aimed at hybrid organizations or organizations with significant social impact and financially sustainable business models. Impact investments are defined as investments made with the intention to generate positive, measurable, social and environmental impact alongside a financial return. Impact investors can be institutions, funds, family offices, and also private individuals. As illustrated, they have diverse financial return expectations, sometimes putting impact first and accepting below market returns, and some others considering finance first. Finally, there are traditional investors focused only on the financial returns, and sustainable or responsible investors that consider environmental, social, and governance or ESG issues when investing. Sustainable or responsible investors screen their investments. They invest only in firms that respect their environmental, social, and governance or ESG criteria.